Hello and welcome back to the Wealth Management Invest Podcast. I'm your host, David Bodamer, with the wealthmanagement.com editorial team. I cover investments. And this episode, I'm very excited to have with us Jonathan McEvoy, who is Managing Director, Investor Relations, and Head of Private Wealth Secondaries Solutions Distribution with Coller Capital. Welcome to the podcast.
Thanks, David. Happy to be here today and look forward to the conversation.
So, I got some questions, wanted to hear a bit about secondaries, hear a bit about what Coller is doing in the wealth channel. But if you could just actually set the stage for us a bit by talking a bit about both about the firm and about yourself a little bit.
Yeah, happy to. I think that segues nicely into the conversation and the subject for today's discussion. So, a little bit about myself. My whole career has been spent in private wealth distribution, specifically alternatives. So pretty much starting post GFC and through sort of multiple managers, and joining Coller in 2022 as the firm, which has a long history of focusing on secondary investing going back to 1990, where Jeremy Coller did the first secondary transaction in the mid 80s, really kind of pioneered the space. But the organization as a whole really kind of focused more on the institutional fundraising and constructing secondary offerings for institutional clients. With joining here, really it was an evolutionary move by the firm to broaden that distribution because secondaries made sense. And with my background, here to build out the US capabilities with the resourcing. Coller, as I mentioned, dates back to 1990, pioneer in the space. Today we're 40 billion, over 300 employees. I sit here in New York City, but we're headquartered in London with 10 offices globally. So a global reach and certainly a focus exclusively on just secondaries.
So, why don't we start also just talking a bit more about what the world of secondaries entails? Is that both debt and equity? And just flesh out a bit what that actually means for folks who may not understand what that term entails.
Yeah. So when you think about the secondary market, and it's becoming something that you're seeing more and more in sort of the financial news and media, the secondary market largely exists as a liquidity provider for investors who own private market assets with an illiquid structure. So if you invest in a private equity fund in the traditional structure of a capital call drawdown 10-year term structure, you're going to have that extended illiquid period. And if you're in need or searching for liquidity prior to the end of that term, you really don't have an outlet. And that's really where the secondary market was born from. So looking back in 1990, at the start of Coller, that year's transaction volume was about $1.5 million. Last year, it was a record year for the secondary market. It transacted about 160 billion. And this year, through the first 6 months, depending on what broker you review or follow, through the first 6 months, we're at about $100 to $105 billion of transaction volume. So we're on pace for another record year if it maintains at this pace. And what's notable, inside, those numbers is really sort of the evolution. So within the secondary area of the market, specifically how the business came about was on the equity side. So private equity assets. That was sort of the forced foray of where our focus is. And actually, in the evolution, as we've pushed innovation, actually, we did the first GP-led secondary transaction in 1996. It wasn't categorized as such. Today, that's the fancy name that we provided. But back then, it was called a fund restructuring. And so this is where, it was a private equity firm who identified, an asset and was looking for alternatives to provide liquidity to their LPs and hang on to an asset longer because that asset had what they felt, continued upside from a growth perspective. But as the industry has now sort of evolved and grown, the GP-led side of the market is about 50% of the overall transaction volume. And beyond that, that's just the equity side. Today, with the proliferation and the growth on the private credit side, really kind of stemming from post GFC, where you've seen private credit funds, really kind of step in where banks sort of pulled away from lending to sponsor-backed businesses. That's a major area of the market where that primary market has developed. And because of the illiquidity of that structure, which is slightly inside of private equity, but still an illiquid structure nonetheless, you've seen a secondary market grow there. And so we at Coller actually focus both on the equity side as well as the credit side. And I would say, it falls in line very well with sort of our focus as secondary investors. But, having teams in place that focus on equity as well as credit, and being a first mover in both, serves us well.
So when we're talking about private markets, there's a lot of talk about how there are fewer public companies these days and what percentage of the market is no longer available on those indices. And then there's also often talk of, companies staying private for longer. There's all these dynamics that seem to be feeding the private side. How do secondaries fit into that matrix as well, into this overall trend of more companies being private, more companies staying private, et cetera?
Yeah, this has been a trend that you've seen where the number of publicly traded companies has been in a steady decline. There are a few statistics that you'll see out there, depending on how you sort of cut up and slice the data. But, the statistic that we repeatedly see is just, companies of substance, right? So companies of over $100 million of revenue, and what's the percentage that are public versus private? And, the number of private companies with that scale, right, size, revenue over 100 million, it's around 90% of the businesses. So you really kind of, want private markets exposure and in your portfolio to be more holistic, right? To capture more of those businesses, those companies that you're just not able to access by just investing in traditional stocks. When you think about more recently, David, the motivation and the tailwind for secondary investing, it's really a function of a lower distribution environment. And that's really kind of started in 2022, where you saw the Fed begin to move off of zero interest rate policy. And then you had, geopolitical risk that was introduced to markets, which created volatility and uncertainty. And when you have that, that is typically an environment where you see lower capital markets activity because of that uncertainty. And that's just prolonged. And here we are that far removed, and you're still dealing with an environment for owners of private equity, private credit as well, where private equity firms who typically will look to exit their portfolio companies via an IPO, via a sale to a strategic buyer or another private equity firm, that activity has been quite muted from, I would say, a normal environment. And when you have that,
right.
You have an owner of private equity who's expecting a certain level of liquidity from their private equity portfolio that they're not getting. And when you have that, they're really experiencing a liquidity shortfall. And so when you have that scenario, they need that liquidity for whatever their reason. And the outlet that they have with that private equity portfolio that's continuing to grow, that's performing, that's of quality, they can go to the secondary market. And that's been a big driver of why you've seen supply come to the market. Now, the secondary market also exists because private equity has become such a meaningful exposure in institutional investors' client portfolios, in institutional portfolios. And so when you think about that dynamic, that's a function of the secondary market has become a viable liquidity tool for these owners. And they could be using the secondary market as a portfolio management tool. So you could have a large institutional investor who owns private equity in a quite meaningful way that's looking at the secondary market and just programmatically coming to the market repeatedly, when they want to sort of make strategic tilts and shifts in their private equity portfolio, much like you would make in your public equity portfolio if you're moving from domestic to international or growth to value. So, you have a number of drivers, but that's just to come full circle on sort of, the motivation today for, why the secondary market is attractive, but, why, companies ultimately maybe staying, private for longer.
And from an investor standpoint, for someone investing into secondaries or secondary funds or what are the vehicles that are available, it seems like some of the benefits might be like when you think about traditional private equity, there's the J curve. But if you're coming into a secondary, I would assume that you're getting into something that may be more stabilized and maybe cash flowing, or maybe it may be in a different position in the cycle. So it's got like maybe a different profile than if you're coming in from like just a more vanilla traditional private equity thing. And the other benefit that I would think that maybe there is the vintage diversification you could achieve. Like even if you are wanting to get like a broad private market exposure, and maybe you do want to get into, again, like a more traditional vanilla thing, but if you couple that with some secondaries, you can get exposure to stuff from over the years and create like, kind of like a more robust portfolio. Am I on base with any of that?
Yeah, and I have a simple illustration to sort of highlight all of that, of what's the benefits of secondaries. And so, I kind of like to use this with clients when I speak to them to explain sort of secondaries at the onset, which is, if I brought you to a racetrack and I gave you the ability to, bet on the horse at the start of the race or halfway through,
Mm-hmm.
what would be your preference? It's obvious, right? It's halfway through, right? You kind of, see who's, coming out of the gates fast, who's performing well. You have the ability to sort of call the race much better midway than you do at the beginning. That's what secondary investing is. So everything you just highlighted, it's essentially the benefits and why secondaries are a great way to invest in private equity. We typically are investing after the initial investment period. So that mitigates the J curve. What's the J curve? The J curve is essentially, when you commit to a private equity firm, they'll take a number of years to call your capital, to identify companies, invest in those companies. And it won't be until, a future time where you start seeing the value creation, where, the value of those assets start appreciating. As a secondary buyer, we're buying in already where the assets have been identified. And so you reduce your blind pool risk, right? We really like secondaries because you can touch and feel what you're about to own, right? So we can price it accordingly. It mitigates the J curve. And because you're buying into these seasoned portfolios, meaning that, money's already in the ground, you get this cash flowing component, which is a really powerful risk mitigator. But because you're buying into a portfolio that's going to be heavily, heavily diversified, the diversification is going to extend to much greater than just vintage diversification. It's going to be number of private equity firms that will own
Mm-hmm.
that you'll get in a single investment, number of different individual companies. We're sector agnostic, so you pretty much get the whole gamut of industries and sectors. Vintage diversification, which is really key because you want to spread out, when that money goes into the ground, so you're not subject to any sort of adverse year or batch of years where
Mm-hmm.
it was less optimal. And so that's the beauty of secondaries, is basically getting a head start on a portfolio that's already in the ground, and getting the diversification. And so, David, beyond that, not only do you understand sort of the assets that you own, but you get this broadly diversified portfolio, and you're acquiring these assets typically, right, at a discount because of the market supply demand mismatch. And I could speak to that in a moment. But when you get all of that, you put that together, you get really solid downside protection, right? Which really mitigates principal impairment. And as a high net worth investor, as a financial advisor advising clients, right, that's the first really kind of tool that you're thinking about when you're considering, not only what's the expected return, but what's my risk of impairment or loss. So really important to kind of know that about secondaries is not just the outright return that you're going to achieve, but I'd say the risk adjusted return with the downside protection that you get.
Yeah. And so something you alluded to was going to be, I think, my next question here, which is when you look at the opportunities for sourcing secondaries, what is that like? How do you diligence that? I mean, imagine there are a lot of opportunities. So how do you kind of identify like the best ones?
So the beauty of secondary investing, and at Coller, we may be biased when we say this, but we think secondary investing and being a buyer is always great. And the reason is that secondaries, The market is significantly undercapitalized. And so that provides you as a buyer a significant advantage because of that supply demand mismatch. And to give you an idea, and I want to start here before I kind of get into sort of the sourcing, but this is sort of, if you look at the total addressable market, in any secondary market, it's a function of the primary market. Today's primary market for private equity assets, holistically, globally, is around $11 trillion of NAV. Last year's transaction volume was 160 billion. So
wow. Okay.
if you look at that, right, that right there kind of confirms kind of what that supply demand imbalance that I'm speaking to, right?
Yeah.
One, it speaks to sort of the opportunity in front of you for secondaries, right? So even though you're hearing more and more about it, right, the path forward, the growth is significant. But that supply demand mismatch really kind of is something that we lean into. Why? Well, one, we have the biggest investment team dedicated to secondary investing. It's almost 2x larger than the next biggest competitor. That big investment team is situated, intentionally. When you look at the makeup of that team, half the folks are principal, partner level, senior folks. They're sitting in our global offices, tasked with really cultivating relationships with the biggest owners of private equity, right? It's no hidden secret who owns private equity. So they're pursuing those relationships to really cultivate those relationships, to drive a relationship, and with our independence, approaching it in a consultative approach to understand and sort of have that relationship for when that institution has a need for liquidity, where we're their first call or their second call, right? So we can bring expertise, we can bring certainty, and obviously as a scaled buyer, we can bring a checkbook to really help them if they do have that liquidity issue. It extends beyond that, right? So not only the biggest owners of private market assets globally, but also the biggest GPs. So we want to understand what GPs are dealing with, right? We want to help them if they have investors that need liquidity. That is a major source of how we get deal flow here at Coller. But there's other ways that ultimately secondary markets sort of provide supply, which today, if you look at the investment banks, in Midtown Manhattan, they all have teams today that are staffed with folks that are covering sponsors, so private equity firms, as well as teams that are out there talking to institutional owners of private equity assets, right? For really pitching them on if they have a liquidity problem to run a sale process, right? And when you run a sale process, you're essentially running an auction where you're drumming up a lot of interest. And so with a lot of buyers out there, these brokers are kind of playing that middle man to drive an auction process to drive top price for the assets that seller is looking to sell to get liquidity. And the motivations could be a whole host of reasons why they're looking to do so. But for Coller, looking at the big investment team that we have, we really lean into that size, that global reach as the sourcing engine for us, right? Because that really can lend itself to working with sellers, right? Motivated sellers, and doing so at a greater premium, or for a transaction that we really kind of want to tailor to fit our buy box. But ultimately, it flows through to the more folks that we have out there having conversations, the more ideas we have coming through our IC every week. And it allows us to just be highly, highly selective in an environment where you just have that supply demand mismatch that works into our favor from the start. So hopefully that's helpful on sort of how to think about the market.
Absolutely. I do want to pivot now to this question of what it means to bring the opportunities to the private wealth channel. So we're at this time where there's increasing talk of democratization of private markets. There's a lot of innovation. There's a big explosion of there's a lot of innovation in wrappers and bringing investment opportunities in ways like different from the traditional kind of drawdown vehicles. So how does what you're doing fit within, how are you bringing opportunities to a lot? I know we can't probably name like specific fund names. There's all that, compliance stuff, but in the broader terms, like just kind of style of funds and, or wrappers, or if you could just talk a bit about what you're doing in the private wealth space.
Yeah, I think when you think about any investment in a structure, I think at the core you have to think about, is the structure does the structure lend itself to what the underlying strategy is? And
Right.
does the underlying strategy and the liquidity of that specifically lend itself to being in a more liquid structure? And so for the majority of private market assets, that's not always the case because of the illiquidity. But secondaries, because of the seasoning component, because you're buying into these funds midlife, and because they're cash flowing immediately because of the broad diversification, but because that broad diversification across vintages, you see meaningful return of capital every year. And so at Coller, it was natural for us to go in this direction because what we've been doing for 35 years, with an investment team that's been built out, with that sourcing engine that's global, with an IC process that's been refined and continues to be re-underwritten to improve outcomes. We are taking those outputs, right? So the transactions that we source and bring through our IC and approve, we can bring those and put them into a perpetual structure. And so secondaries lend themselves very well to a semi-liquid structure. And what I would say or argue is that in the structure, as an investor, what are you really looking for? Well, your appetite is potentially changing. So you can still do a closed-ended structure, or you can consider a perpetual. And in a perpetual, really, what are you picking up? The huge advantage for a perpetual structure is that you don't have a multi-year investment period. You don't have a high minimum investment. You don't have a high client suitability requirement. You get a much more friendly sort of tax reporting in the form of a 1099. And then you put that all together and you get a cash flowing portfolio that's not only going to be core because it can provide you a single investment that's going to give you broad diversification across GPs, individual companies, sectors, vintages, as I mentioned before, but because of the cash flowing component of secondaries, rather than the cash flow just going out the door back to you as an investor, where then you have to make a decision of where to redeploy that. But the recycling of capital that's happening inside a perpetual structure is giving you that all-weather feel because you're getting the repositioning as you're moving through time. And so, coming to private wealth, introducing these new structures, specifically in these perpetual structures with a $50,000 minimum or a low minimum, lower suitability at the accredited level, instant investment, so you're not investing over a multi-year period, a 1099. It really is a great solution. It's a great way for advisors that, where they have clients that are either considering alternatives or they need to increase their alternative usage. It's a great way to get that core exposure to private equity, private markets, and really kind of then from there kind of build off ancillary exposures and sort of start that process with your clients. And because you're in private markets, this isn't public markets, so you have the natural sort of dampening of volatility that that should be lower than public markets. And because secondaries are so broadly diversified, you get something that really provides you really strong downside protection, right? So it mitigates principal impairment and allows you to compound efficiently, which is the name of the game for what clients are really looking for, in their investment portfolios.
So what is your experience like in just interfacing with the advisor universe and talking about, secondaries, talking about your opportunities? What are you finding in that world?
Yeah, I think there's a lot on advisors' plates and a lot on investors' plates, right? Investors outsource their investment to their advisor, who really is there to construct, a portfolio holistically. There's a lot that they have to do, right? So even in today's environment where alternatives are more commonplace than they were 5 years ago or when I began 10 plus years ago, education is still important. And I would say it's quite essential. That could be educating the advisor, or it could be extending all the way to educating the client, on why secondaries, right? The misnomers that they may have on secondaries and overcoming that, right? How to really prepare folks to understand sort of what they're investing in, which I think is critical on something that you have to do, especially as a sales organization, which is sort of, how I sort of is the ethos of my sales team as we're out there talking to advisors and clients. So education is really important. The next is today, it seems like there's a lot more folks that are moving into private wealth because they see the opportunity. They're using secondaries. So advisors and clients are seeing a lot of different managers doing a lot of secondaries, but they're different, right?
Mm-hmm.
It's a generalization to say that you do secondaries. So really then beyond the education of why secondaries, then it is, how do you differ, right? So how does Coller approach secondary investing? What are you owning? And that's really important too, because, some portfolios may be made up of secondaries plus co-investments plus primaries. We're secondaries only, right? So what's the advantage of that? And what do you mean LP-led and GP-led secondaries? So then digging even further into sort of the difference between LP-led and GP-led, especially because they're hearing more about GP-leds being a major source today and a growth area of the secondary market. So education is really important. And that's beyond not just the investment themselves, but the structure, especially for newer clients that, this will be their first foray into alternatives. This structural difference is going to be obviously something that will be different from your traditional stocks and bonds. So educating them on what the expectation is on a go-forward basis of, this new structure that you're introducing them to with this secondary exposure.
And I know Coller's, globally, you're not just serving the U.S. You're doing things everywhere. Is there any interesting things you found in trying to service the private wealth market in the U.S. versus what it's been like other places?
There is a difference. We are doing this on a global basis. Jake Elmhurst here at Coller, is sort of the architect, senior partner at the firm, was 25 years at UBS, built the sort of the placement business there on the private equity side, then moved to the private bank as he built out their private markets business. And what was great about that is that he did that both in the US as well as in Europe. So he really saw and really had that vantage point of seeing sort of how you need to build this and also how to succeed both in the US, which is a different market than ex-US. Mm-hmm. And ex-US, I sort of lump that all together. Even there, right, you're dealing with different regions from, even just north of our border in Canada to Europe, to Middle East, to Asia, to Australia. There's significantly, differences, and that's just, in the size of the team that you have. It's the structures that you have locally in those respective regions. And so, yeah, we're doing it on this massive global basis. We're about 70 folks. But what's notable and, what you should sort of be looking for any firm that, is coming into the private wealth space is, what is your commitment to it? Because of the 70 people, only half of those are distribution, right? So, we're inside Coller, which has been around for 35 years, as I mentioned. We, are a firm just over 300 employees, but those new employees, of the 70, half are distribution. The other half are actually the infrastructure that you want to have to support this broader business. So that's legal compliance, that's controllers, that's finance, that's marketing. These are all critical pieces as you're scaling and growing a business for the long term. And that's our commitment. So, you can do that, with patience, but you also need to be resourced. And that's certainly something that, we at Coller are committing to. And, that's being bought in by, the whole firm as we look, to embark on this endeavor, which is not so new anymore.
Well, I've taken a good chunk of your time and you've answered all my questions here. I just, before we wrap up, I just wanted to give you an opportunity if there are any sort of either takeaways or points that we didn't get to that you might want to leave the audience with. And also if folks want more information about either you or about Coller, where should they go?
Yeah. Well, David, I appreciate your time and really appreciate everyone, all the listeners' time to hear us for this lively discussion on secondaries and the opportunity and how it can be um, beneficial for clients. Love to open up a discussion and have you reach out to Coller Capital. Everything is accessible through our public website. We have all that correspondence, but please feel free to reach out. You can reach out to me directly, and would love to start a discussion and certainly talk about sort of the Coller, our platform, and if there's ways that we could partner and work together. So thank you so much.
Great. Thank you. You can find me on LinkedIn. You could also find, our coverage, ongoing coverage at wealthmanagement.com in our investment section, where we cover alternatives as well as ETFs, mutual funds, SMAs, model portfolios, all the kind of building blocks that folks are using these days. So I hope folks, if you have found this through some other method, please check us out there.